Hi everyone, welcome to this Economic and Financial Quarterly Outlook. I'm Martin Lefebvre, Chief Investment Officer, and I'm with Louis Lajoie, our investment strategist.
Hello, Martin.
Hello, Louis. Louis, last year was very challenging for investors. Asset classes were down markedly, whether it's fixed income or lots of volatility also in equities due to rapidly rising inflation and central banks raising rates like never before. But since the beginning of the year, there seems to be a sort of a sea change, a sector and geographic rotation happening in equities. Is it sustainable? What's in the cards for 2023?
Right, indeed. I think before jumping to conclusions after just 2 weeks into 2023, or even before delving into all the details of our outlook, I think if I was to summarize the current backdrop with one image, I think we could use the image of a slippery road. And let me explain what I mean by that. What I mean by that is that over the course of the past few months, we've had a number of indicators flashing red, signaling greater risks than usual, whether it's the yield curve inversion of our leading indicators edging lower.
So, or the stock market itself.
Notably, the stock market is one of them, definitely. So that's one thing. That's why we're talking about a slippery road. And the other thing is that the key challenge for 2023 is going to be in the hands of the Federal Reserve, namely their capacity to reduce inflation without inflicting too much damage to the economy. And that's no small task. That's a slippery slope for sure. That's not an easy thing to do.
Yeah, indeed. I guess inflation was the highest risk in 2022 throughout the year. Where's the latest numbers? What's inflation telling us nowadays?
So the short answer is it's still high, but it's moving lower. We're turning the corner here, and that's what we can see on the chart here, where we're looking at different contributions from services inflation, goods inflation, food and energy. And what you can see is that before 2020, food and energy prices are fundamentally volatile.
Yep.
So on any given year, it could be up or down, generally not sustained in a sustained way. That's what the red bar are showing. Goods inflation used to be zero for the most part, such that services inflation was the key component for inflation. Now, in 2021, 2022, we got a perfect storm with all of these contributors edging and shooting higher, like in some instances like never before. So that was a perfect storm. Now we're turning the corner. Oil prices are 40% below their recent peaks. Goods inflation is edging lower. Used cars are down year over year. So
there's even
shifting.
deflation month over month.
Exactly, and there's good reasons to believe that that's going to keep on going over the next few months, such that the bottom line here is it's now all about services inflation, which edged persistently higher throughout the past year, remains very high, and that's what we're going to be looking very closely over the next few months.
Yeah, as you explained, usually it's very stable, somewhere around 2%. And that's why most central banks are targeting precisely a 2% inflation number. But now we saw it increase very rapidly throughout the course of last year. What's behind this increase, and what's in the cards for 2023?
So again, as an economist would say, it's complicated, but for the most part, services is people getting wages. Wages depend on the state of the labor market. And as we speak, the labor market remains very, very tight. For instance, we're looking here at the unemployment rate in the U.S., which edged back down near a record low. So 3.5, last time we saw that was in 1969, bearing for a month or two here before the pandemic. So very, very low. Demand for workers is also extremely high, as shown by the ratio of job openings, so job offers per unemployed worker. We're turning the corner again here. We've seen numbers higher in a few months before, but at 1.7, it's still in levels that we had never seen before the pandemic.
And it still shows the scarcity of labor as we speak.
Definitely, definitely. So that's what we're going to be looking very closely, for sure.
The problem, it seems, though, is that usually once you enter a recession, it goes up very rapidly. We saw a few big firms in the U.S. starting to show that they were about to lay off workers. Wage growth have slowed down a little bit. So is it all just lagging and bound to happen, or is this something that will bring central banks to stop hiking interest rates in the near future?
Right. So by definition, the labor market and wages are lagging. Lagging to what? Lagging to central banks' action, namely rate increases. And we've had a lot of that over the past year, obviously, over just the span of 9 months. So they started in March. They've hiked by 425 basis points, so over 4% in 9 months. That's unprecedented. And as a result, we should see the economy slow down over the course of 2023 and notably the labor market.
And that's basically what they're trying to engineer, right?
Yeah, that's the goal.
Slowdown.
Yeah, so they want to engineer a slowdown in inflation. And according to our forecast and taking in all together the goods inflation that I discussed, if energy prices remain stable and ultimately services inflation starts to edge lower, then we should see a sustained slowdown in overall inflation below the Fed policy rate, with perhaps 1 or 2 more rate hikes. We'll have to see, but clearly the point here is that we're getting very close to a point where central banks are going to want to press the pause button. We may already be in that environment our side of the border. Our economists believe that the Bank of Canada last rate hikes was their last one of this cycle, so we'll have to see. But
they've certainly opened the door to that.
They've opened the door to that, but in any event, if it's another or 2 more rate hikes, it's marginal compared to what we've seen. And at some point this year, perhaps as soon as the end of this quarter or early next quarter, we'll be in pause for central banks. So yeah.
Okay. So, but the banks are still guiding towards maintaining that level at a fairly high level for the foreseeable future, while the markets are sort of expecting that there could be rate cuts towards the end of the year. What's your take on that?
Yeah, that's where it gets complicated. I think it's a little early to discuss rate cuts at this stage. We may get some rate cuts ultimately this year. Things can evolve very fast. But since the central banks were caught off guard, completely off guard by inflation over the past 2 years, they're going to want to be really, really sure that inflation is in check, that they've essentially accomplished a sustained slowdown in inflation. And to be 100% sure, that means that they'll likely be patient before they cut their policy rate, in fear of potentially having to deal with a second inflationary wave down the road, which would be very detrimental to their reputation, to their credibility. So in other words, the key point here is rates will likely remain high for a prolonged period of time. And at this stage, they're already as restrictive as they've ever been over the past 40 years. So that's a signal of some slowdown over the coming months, that's for sure, in the economy.
Yeah. So clearly some form of a slowdown ahead of us in 2023 and perhaps even at the start of 2024. But owing to the fact that the labor market is very strong, very tight right now, is that attenuating some sort of the slowdown in some ways? Or what kind of expectation do we have for growth?
Right. So that's why our base case is stagnation and not doom and gloom economic recession. There's a structural factor behind the current labor market, namely demographic factors that ensure some relatively good level of employment on a sustained basis. So it's hard to imagine a significant rise in the employment rate given this labor shortages that are more structural. So that's why one of the key reasons why we expect more form of economic stagnation. We may get 1 quarter or another of negative GDP growth. We may see recession headlines in the newspaper, but fundamentally speaking, we expect that this is more some form of stagnation than a genuine recession, although, as you can see on our scenario table here, a genuine recession.
To the downside.
Definitely. So odds are relatively high that it eventually will be defined as a true recession.
Yeah, and like you said, it's not all doom and gloom. There also could be a bull case in all of this. If inflation does go down faster than we expect, then central banks can refocus their attention towards generating more economic growth, and that would be a clear positive for all sorts of markets in 2023 and 2024.
Yes, definitely, and that relies on what happens in the labor market front. If I'm here, as you can see here, trying to summarize in a few takeaways what we discussed. So
that'll be the key to monitor in 2023, labor markets.
Definitely, because labor market conditions imply what's happening to wages, which imply what's happening to services inflation, and that's what the Fed wants to be sure that we're heading towards more stable and lower inflation figures. So that's what to monitor. That's what's going to guide whether we end up in the optimistic or more pessimistic scenario. Again, our base case is more of a form of economic stagnation with lower inflation and ultimately a pause by central banks. And for markets, for investors, as we discussed a bit earlier, there's a chunk of that, these risks that's already being discounted in financial markets. Most notably, I believe, in the fixed income space. So we've seen yields move higher over the course of last year. We've increased a bit our allocation to that asset class. That asset class could do fairly well this year and further down the road if indeed inflation ultimately moves down and opens the way to rate cuts. So that's why we have, broadly speaking, a more defensive asset allocation as we speak. We expect a sustained period of volatility, and that's why we favor a bit more cash at this stage, a bit less equities tactically, but broadly speaking, we are defensive and focusing on areas of the market that have historically shown better resilience to variations in the business cycle. So that's our stance right now.
Well, Louis, thank you very much. Thank you everyone for tuning in. We hope that this was helpful, and we'll talk to you very soon. Thank you very much.
Thanks.